You must avoid these 12 trading mistakes to become a great trader. If you want to be a successful trader, you need to avoid making many of the common mistakes most traders frequently make. You will make mistakes as you learn to trade, but the traders who start making money are the ones who learn from their mistakes and figure out how to avoid repeating them. In this video, I'll point out the most common mistakes traders make and offer some simple solutions to them. It is then up to you to learn from them and avoid them as you continue to analyze and trade the markets. Mistake number 1. Being involved in too many trades at the same time, as well as overtrading. This is perhaps the most common mistake that all beginners make, and also about 90% of the traders make. Furthermore, it is unsurprising that approximately 90% of traders lose money in the long run, when approximately 90% of them trade excessively. Another interesting fact is that if you find yourself in multiple trades at once, you're probably trading too much. There is no logical reason to be in more than one trade at the same time. Most people simply cannot learn to ignore the temptation to be constantly in a trade, so they invent all kinds of reasons why they should trade or make up trading signals that are not actually there. The cold hard truth is that you will never make money unless you learn to control yourself and stop over-trading. Perhaps the simplest and quickest way to train yourself to stop over-trading is to simply change your perspective on trading and what making money in trading entails. When you remember that less is more and that you will literally make more money by trading less over time, you will begin to look for reasons why a potential trade might not work out, rather than trying to find any excuse to enter the market like most traders do. Mistake number 2. Wasting too much time thinking about trading and looking at charts. Thinking about trading too much is similar to overtrading. Traders frequently make the mistake of spending too much time repeatedly flipping through the charts, even when there are no obvious price action signals to trade. As a result, they end up making a trade that they would not normally make if they were following their trading plan. If you find yourself thinking too much about the markets and trades you opened all of the time, it is safe to assume you're overtrading and losing money as a result. You must plan time away from the charts into your trading strategy. Then, if you stick to your trading plan, those regularly scheduled times away from the charts will just be part of the plan and part of the process. If you begin to deviate from the process and end up losing money as a result, you are solely responsible. So, in the end, it all boils down to how good you are at staying disciplined and adhering to a plan, which is why most people lose money at trading. They certainly can't stick to a plan and stay disciplined over a significant period of time, consistently. Mistake number 3. Making trading decisions based on short-term charts. Day trading is one of the most common mistakes that new traders make. Many people hear the term day trading before learning much more about it. This sets them on the wrong path right away, starting them on a cycle of trading off of short time frames, like the 5-minute or 1-minute charts, which leads to severe overtrading, gambling, and trading addiction. Lower time frame charts simply are not as important as higher time frame charts. The reason for this is straightforward. The longer the time frame, the more data it reflects, and thus it carries more weight than a shorter time frame. A daily chart bar, for example, is far more important than a 1-minute chart bar. Higher time frames require more patience, but in exchange, you gain more profits and more accurate trading signals and less stress, which seems like a fairly decent trade to me. When trading daily charts, you can simply set up a trade and walk away for 24 hours or more. This is how to trade like a nomad and enjoy the benefits that trading can provide. Mistake number 4. Trading with real money before practicing a strategy on a demo account. This is a death sentence for your money, but it happens all the time to new traders. The error is to trade with real money before testing your strategy on a demo account. What usually happens is that some traders are very unfamiliar with what they do and how it works, so they make silly mistakes like risking more than required or failing to enter a stop loss properly, and so on. Of course, they lose money as a result of this. Furthermore, because you have not tested your trading strategy on a demo account in live market conditions, you have no idea if your strategy or your ability to trade it will be effective. Your mission as a skilled and profitable trader is to test your strategy as well as your trading ability on a reputable demo trading platform before you try trading life. This will allow you to work out any bugs with the platform, as well as get a feel for the market and your trading method without putting real money at risk. Mistake number 5. Ignorance of the fact that every trade has a random expectation. Most traders make a big mistake when it comes to trading because they don't realize that every single trade they take has an equal chance of ending in a loss or a win. That is not to say that you cannot have a high percentage winning strategy. You can. But the thing about trading is that there is a random outcome of wins and losses for any given series of trades, so you never know the sequence of wins and losses in a sample size of trades. If you expect your strategy to win 60% of the time, you can anticipate that percentage to appear over a large enough sample size. It's the same as flipping a coin. You know you'll get heads 50% of the time and tails 50% of the time, but within that 50% expectation, you can have, say, 10 straight heads in a row, which could be confusing if you didn't realize you had to flip the coin a lot of times to get 50% heads. The same is true for trading. You could lose 10 trades in a row within a sample size of 100 trades, but after those 100 trades, you could still win 60% of the time. The ramifications are enormous. If you don't stick to your trading plan and remain disciplined even during that losing streak, you're going to freak out and overtrade, potentially blowing out your account. Mistake number 6. Feeling a strong desire or urgency to trade. Feeling a sense of urgency or desperation around trading and being in many trades is a huge thinking error that many traders make. This results from essentially putting all of your eggs in one basket, the trading basket. This is a huge mistake because trading is inherently risky and difficult because it requires mental strength that many people don't have or are unwilling to develop. As a result, you must recognize and accept that trading cannot begin as your plan A. And even if you get really good at trading and start making consistent profits month after month, you should absolutely keep a side job or side hustle and avoid putting all of your money at risk in the markets. You could even have a long-term investing or stock market strategy or something similar. Whatever you do, don't put all of your eggs in one basket because you'll be putting too much pressure on yourself to make your trading profitable. If there is one sure way to fail at trading, it is to put too much pressure on yourself to succeed. Trading success comes when you remain calm and collected and you don't care if your trades win or lose. That may sound ridiculous, but I'm telling you that if you devote too much emotional and mental effort to any one trade, or even to your trading in general, you've already decided to sign your death certificate in the market. Mistake number 7. Too much babbling, not trusting your decisions and sticking to them. When you enter a trade, you must stick with it unless there is a significant shift in price action on the same time frame on which you entered the trade. Please think over what I said at least 10 times to ensure it fully sinks in, because it is critical to your trading career. You see, very often, traders will spend time analyzing the market, finding a trade signal, setting it up, and placing it, only to return an hour later and start freaking out because the price has moved against them slightly and they are seeing negative sign to their open trade. I am sorry to break it to you, you will have negative trades and losses, but if you freak out, you will lose money. This relates to the previous point where I discussed a random outcome of any given trade. You simply cannot afford to place too much emphasis on any single trade because it is irrational to do so when it is the aggregate of trade outcomes that matters, not any single trade. As a result, you must not dither on every trade you enter. Instead, you must let them play out and let the market do the thinking so that you can trade stress-free and profitably. In other words, get out of your own way and let the process do its thing. Mistake number 8. Chasing a signal you missed, entering late and at a high cost. It happens all the time. You saw a trade setup you liked and didn't enter it for a variety of reasons, then returned to the charts later and saw price take off in your favor without you aboard. It can be aggravating. However, you don't want to enter the market after it's already taken off without you. Simply wait for the next opportunity and keep in mind that the market will be there tomorrow. So, don't be in a hurry to trade or enter a trade that you missed because this is emotional thinking. will only cause you to lose money. Mistake number 9. Not defining your per-trade risk allowance in advance. Do you know how much risk you're willing to take on per trade? Is it a sum you are willing to risk and sleep well at night despite the possibility of losing? If not, you will need to make some changes. Many traders don't even sit down and figure out how much money they are willing to lose per trade, let alone make sure it is an amount they're financially and emotionally prepared to lose on any given trade. If you haven't not done this and are trading live, you should stop trading until you figure it out. Mistake number 10. Not keeping records of your trades. Keeping a trading journal is a critical step toward becoming a successful trader. It is not as simple as simply recording your entry and exit points for profitable trades. It necessitates a bit more information and focus. All trades, good, bad, and really bad ones, should be recorded in your trading journal. The following types of information should be recorded in a trading journal: what instrument is being traded on what date and time, screenshots of the chart configuration at the time the trade was entered, position size, your thoughts and reasoning for entering the trade. With a trade journal at your disposal, you can go back and review your successful trades, as well as trades that were less successful. In order to highlight opportunities in your trading strategy you can improve for better performance. Mistake number 11. Letting profitable trades turn into losses. You are not alone if you are making this mistake. Even the big guns make this common trading blunder. How many times have you perfectly timed your entry, seen a nice paper profit, only to see it vanish due to a sharp reversal? Allowing a good trade to go bad is the first major mistake you can make when trading the financial markets, but there is hope. The best way to correct this error is to plan ahead of time. Before you enter the trade, you should know when you intend to exit. You can also scale back on your trades. Take a portion of your position when it becomes available in the market, a portion more as the move progresses, and some to hold for big wins. This method will assist you in protecting your profit. Number 12. Revenge trading. You despise it when you lose? And you just want to get back into the market, take another trade, and show that you can win? That is precisely the reasoning behind revenge trading. You want to exact your revenge. You want to show that you are a winner. However, most of the time, revenge trading causes more harm than good. Take a moment to consider this. You are probably not in the best emotional state when you engage in a revenge trade. You are probably still fuming or too stressed to make a sound trading decision. And it is very likely that you have not thoroughly examined the next trade, whether it has good potential or not. So, the best thing you can do about revenge trading is to avoid it entirely. If you have a losing trade or a string of losses, you should take a step back and analyze what went wrong. Was the market too choppy to trade in the first place? What went wrong with your preliminary assessment? It is best to avoid revenge trades at all costs, most of the time, if not always. Conclusion. You will make mistakes as you learn and trade the markets, especially when you first begin. But it is the ability to learn from mistakes that separates the winners from the losers. Those traders who go on to make significant money from the markets are not those who never make any mistakes, but rather those who learn to avoid and learn from the mistakes discussed in this video. It's all too easy to make the same trading mistakes over and over again until your trading account is depleted. Your goal is to avoid this happening to you. Good luck. I wish you successful trading.